Hey, good morning. This is May Valensky with Driving Markets. Driving while talking about markets. Obviously, anything said in this piece is a opinion only. So let's kick off as to what we're at. Okay. Right. So the market's been very, very quiet. They've sort of slumped a little bit this week, but not a real major slump. They went down yesterday. The US markets popped up, not much, but the Dow was up about 130, 140 points. So it's not really significant. And there's not really a lot going on. Today in the US, you've got the PPI, which is the Producer Price Index, and that is the inflation measure at producer level. That would give an indication what it's costing manufacturers to produce goods. Now, that the cost of goods, as well as we've seen over the last year, has just gone up. Not only goods, also energy prices and also food. Prices in the supermarkets are just increasing all the time. But let's focus a bit on the manufacturing side. So the manufacturing side, they've got to get in the raw materials. The raw materials could be anything from copper, cotton, metals, oil, and they've got to refine those, and they've got to get those out to the marketplace. And that producer price index is the starting point, effectively, of the measure of inflation. So what manufacturers will be paying, they'll obviously be passing on to the consumer. Now, if that PPI today in the US comes in higher than expected, which I am suspecting that it is going to come higher than expected, that's going to send the markets lower and the dollar higher. However, if you've been watching driving markets over the last few days, I've been talking about a year-end rally, and it looks like there's a feel within the marketplace. They're talking about equity markets that they want to move higher. In other words, they're discounting any bad news. So any bad news that comes along, they're not paying attention to it. They're not respecting it. What they want to do is they want to push higher. It looks like they want to push higher as high as possible to year end, and even surpass, I know there's going to be a difficult one, even surpass the all-time highs. That could actually happen by year end. However, it won't follow through to 2023. In 2023, what you're going to have is you're going to have a significant drop in financial markets and equity markets. You're going to have a drop in the Dow, the S&P, and the Nasdaq European markets and the UK. What's going to happen is, as the global economies move into recession, and they will move into recession, if they're not already in recession, people are feeling a recession, but officially they're probably going to move into recession, then you're going to have more and more employers cutting back on labour. So you'll actually have in 2023 a rising unemployment rate as a result of cutbacks by corporates on their costs. And the biggest cost in a corporate company is the labour cost. So you'll have more and more companies, especially the high-tech sector, laying off significant amounts of workers. Now, interestingly enough, in the high-tech sector, you have got a lot of dead wood. You've got a lot of employees, a lot of human resources there that actually don't do anything and are inefficient. So to get rid of that dead wood, like Elon Musk did at Twitter, which is a prime example. Also regarding Amazon and Facebook, also getting rid of staff. They're looking to get rid of the dead wood. Okay, the people who actually just float around in their flip-flops and their shorts and don't really do anything, essentially, apart from drink cappuccinos, espressos, and have the dry cleaning delivered at the expense of the high-tech company. So there's going to be a lot of layoffs, and it's going to start off with that particular sector and that sector within the sector. In other words, the individuals that are not really working or producing anything. So you're going to have a rising unemployment rate through to 2023. Other thing to look at in 2023 is you're probably going to have a falling real estate market or falling property market, simply because as interest rates rise, and they will rise further, they're going to eat into the spendable income of the consumer, and the consumer is the driving force in the economy. The consumer, whether it's to do with actual consumer goods or things like real estate or the big ticket items, are going to be impacted and affected. Luxury goods are going to be affected as well. So you are going to have an overall downward trend. Now, that will have a further effect on equity markets and push equity markets down. So I'm expecting a overall fall starting from January in 2023 of around about 30% in stock markets. As far as the dollar's concerned, I expect the dollar not towards the end of the year probably to continue strengthening, and then come into January, you're probably going to have a let's rephrase that. Place that back again. Let's rewind. I expect towards the end of the year, a weakening dollar. I just want to emphasize that. Towards the end of the year, we're going to have a weakening dollar, continuing weakening dollar, especially against the pound, the euro, and the yen. And then come January time, after the holiday period, what you're likely to have is a strengthening dollar and weakening equity markets. Gold's an interesting one, where one of my viewers and colleagues, Rita sent through a note that Saxo may have looked at gold as an opinion going to $3,000 an ounce. I personally can't see that happening, go to $3,000 an ounce, but who am I to say where it's going to go? I can see it jumping above 2,000. If it did break the 2,200 level, then yes, you could see gold rushing up to 2,500 very, very quickly. But if there is a recession, then I'm not too sure what would happen there as regards gold. And technically, it should go up as a safe haven, but who's to know? Because generally in a recession, every asset class is impacted. Now, regarding the crypto and bitcoins, again, I do see, and I say this every day, I do see Bitcoin falling below the 15,000 level. I think it's going to, in January, I think 2023, I think it's going to fall significantly. Overall, the markets, equity markets and crypto markets are trying to hold on to any gains that they've got, but they haven't got enough substance there to hold on through to 2023. Tesla, I'm a massive fan of Elon Musk. I think he's probably the number one CEO in the world. He dropped a little bit yesterday from the number one position as the the richest person in the world. Tesla's going to struggle a little bit over the next few months, and you'll see it fall down to around about the $150 level. But I'm a big fan of Elon Musk, so it's not something I'm saying get rid of Tesla, never buy it again. I think Elon Musk is probably one of the most innovative and exciting, more than a CEO, entrepreneurs that I've ever heard of, ever met, and ever known. Never not that I've met him. I'd like to meet him. So if he watches Driving Markets, you can give me a call and we can hook up together. Okay, that's more or less it. So expect towards the end of the year a falling dollar, rising equity markets, and that lead into, it's a bit like the weather report, that lead into January 2023, and you'll start seeing markets come off again then. All right, Mayor Valensky with Driving Markets. Hope you're all well. You can subscribe, pass a comment, share with your friends, share with your enemies, whoever you want to share with. Speak to you soon.